Problem 1929. We're going to complete a job cost record for one job, and then we're going to record direct materials, direct labor, and then we're going to allocate manufacturing overhead to that job based on the job's size. So, U Technology Company manufactures CDs and DVDs for computer software and entertainment companies. U uses job order costing. So on April 2nd, U began production of 5,700 DVDs, which is job 423, for portrait pictures. And they're going to sell those DVDs for $1.40 per DVD. U promised to deliver the DVDs to portrait pictures by April 5th, and they incurred the following costs. So we have direct labor costs. Notice this is labor time record number, and then it says per hour. So this is direct labor. And then we've got some materials down here that have been used on the job. Polycarbonate plastic for $372, acrylic plastic and refined aluminum for $675 and $135. So U Technology allocates manufacturing overhead to jobs based on the relation between estimated overhead of $495,000 and estimated direct labor costs of $450,000. Job 423 was completed and shipped on April 3rd. So here's our requirements. Our first requirement, we're going to prepare a job cost record and then calculate predetermined overhead allocation rate, then allocate manufacturing overhead to the job. So what we're doing, going back to our slides, we're going to complete a job cost record for job 423. Remember, the job cost record shows the job's direct materials, direct labor, and then allocating manufacturing overhead. And then we just add up the costs and figure out the total cost and then the unit cost. So begin by determining the total amount of direct materials and direct labor incurred on the job. Next, calculate the predetermined overhead allocation rate and apply manufacturing overhead. Lastly, compute the total cost for job 423 and the cost per DVD. Now remember, we're going to round the cost of the DVD for the nearest cent. So this starts off pretty easy. So here is our job cost record for job number 423. And notice the quantity is 5,700 DVDs. So here are the direct materials costs. Where did that come from? It just came from here. 372, 675, and 135. That's all right here. So our job is just right now, we're supposed to calculate the total. So add these up. When we add these up, we get a total of 1182. So those are the direct materials used to produce these 5,700 DVDs. Next comes the direct labor. Where did these two numbers come from? They came from here again, 180 and 260. So we just need to add those up to get the total. And we get a total of $440 of direct labor. So this direct labor costs are the wages paid to the workers working directly on this job. Now comes a more complicated part. We're going to allocate manufacturing overhead. So just to give you a reminder from the slides, remember when we allocated $50 of overhead to job 70, we're doing the same thing. So the date that we're manufacturing or we're allocating overhead is whenever the job is finished. So the job was finished on 4/3, so April 3rd is the date that we allocate overhead. Now, how do we allocate overhead? Remember from another slide, the first step is to calculate the predetermined overhead allocation rate, which is total estimated overhead costs divided by whatever allocation base the company uses. In our example from the slides is estimated direct labor costs. This company uses estimated direct labor costs too. So here is the calculation for that. So again, the formula is you take a total estimated overhead costs divided by total estimated quantity of the overhead allocation base. And they chose an overhead allocation base to be direct labor costs. So it's at the beginning of the period, they have to take the estimated overhead costs for the period and divide by the estimated, in this case, direct labor costs. So we get those numbers from here, 495,000 and 450,000. So 495 divided by 450,000 gives us $1.10. Or you can think of this, if you convert this to a percentage by multiplying by 100, it becomes 110%. So if you like the $1.10 method, what that means is that for every dollar of direct labor costs, and the direct labor costs are right here. Why are we using direct labor? Well, that's what the company chose to use. And you can tell they chose to use it from right here, direct labor costs. So for for every dollar of this, the company has to allocate $1.10 of manufacturing overhead. Or if you like the percentage method, you could just say you take the direct labor costs, multiply it by 110%, and that gives you your manufacturing overhead. So the rate is going to be 110%. They could have allowed us to use $1.10, but they chose not to. So what we're going to do now is take the direct labor costs, $440, times 110%, which is 1.1, and that is the amount of overhead we're going to allocate to this job. So that turns out to be $484. So now we need to do the total costs. So this is simply taking direct materials, 1182, copy, paste, direct labor, 440, copy, paste, and manufacturing overhead, which is right here, 484, copy, paste, and then we're just supposed to add up these costs. Remember, a job, a product that we're making has only 3 costs: direct materials, direct labor, and manufacturing overhead. We're going to add those up, and that gives us 2106. Okay, and then the cost per DVD. So remember, this job produced 5,700 DVDs. So we're going to take the total cost of the job, 2106, divided by the number of DVDs. My spelling is horrible. So 2106 was the cost of the job divided by 5,700 DVDs gives us 0.36947, etc. We have to round that to the nearest penny, so that becomes 0.37. You can put 0.37 or 0.37. Check our answer. Notice how it converted it to 0.37. It accepts either one. All right. Now, the next requirement, we're going to journalize in summary form the requisition. That means we ordered direct materials from the storeroom, and the assignment of direct labor and the allocation of manufacturing overhead to job 423. Wages are not yet paid. So again, to review from our slides, what we're doing is we're going to do the journal entry, and the first journal entry is direct materials. So the way the T accounts work is we have raw materials here on the plus side, but when we order them, like when this $200 was put into job 70, we're going to lower the raw materials, and then we're going to increase the work in process inventory account. Remember, the work in process inventory account is the account where the jobs are being worked on. They are in process. So we're going to convert or transfer jobs from raw materials, which will be the credit, to work in process, which will be the debit. So work in process is the debit. Raw materials is going down. So that is a credit. Notice these two are inventory accounts. So now the question becomes, well, how much were our raw materials? Well, right up here, if you scroll up, this is our raw materials or direct materials section of the job cost record. So we've got 1182. of raw materials that went into work in process inventory and came from raw materials inventory, which is the storeroom. Next, it says journalize the use of direct labor. So going back to our work in process, if you remember from the slides, this $100 were job 70 and the $25 were direct labor. So when we record direct labor, we're just increasing the cost of this job. So we're going to increase work in process inventory, which is accumulating the cost of the job. And remember, it says wages are not yet paid, so that's wages payable. And the amount of wages comes from the direct labor section, so $440. So really what we're doing here is journalizing is just taking these totals and putting them in our journal, which would then get posted to our T accounts. Next one, journalize the allocation of overhead to job 423. Again, this is job 423 we're working on. So remember, we allocated $484. So we know the dollar amounts are 484. But what accounts do we use? Well, we have to go back to our slides. So remember, we are allocating the overhead. Remember, the overhead is accumulated. These are the actual costs on the left side, but allocating them to jobs is on the right side. So allocating means we're lowering the overhead. So we're taking part of the overhead and applying it to the job. So if you remember for job 70, we took $50 of manufacturing overhead and allocated it to the work in process. So the debit account is work in process, and then we're going to lower overhead with a credit. Requirement 3, we're going to journalize the completion of the job and the sale of the DVDs on account. Then it says, begin by preparing the entry to show the completion of the job. So back to our T accounts. When a job is completed, it no longer is going to be in process. So we have to lower the in process account, work in process, and we put them into the finished goods account, which is probably our warehouse. So finished goods is the debit, it's going to go up. And the work in process account is going to go down. Now the question is, well, how much? Going back to our slides, it's the cost of the job. So from our example, job 70 consisted of these costs, which is $450. So when job 70 was completed, we removed the cost of job 70 from work in process. So we have to figure out, well, what is the total cost of job 423? So this is job 423. The total costs are $2106. So those costs are leaving work in process with a credit and going into finished goods. And just a reminder, all three of these are inventory accounts, so they increase on the left side, the debit side. Now, next, journalize the revenue portion of the sale. So we're going to sell these, and we sold them for $1.50 per DVD. So if we sold 5,700 DVDs, we have to multiply it by $1.40 right here, $1.40. And that gives us a total of $79.80. And remember, it said we sold them on account. So that's going to be accounts receivable increasing. And then we have to record our sales revenue. Then it says journalize the cost of goods portion of the sale. So back to our T accounts. Remember, when we sell a job, we sell a product like the job 70, we have to remove it from finished goods inventory. Because it's sold, we can no longer have it in the finished goods inventory. We're going to move it or transfer the cost to cost of goods sold. So COGS gets debited, finished goods gets credited, and that's the cost of the job. So cost of goods sold is increasing, finished goods inventory is decreasing, and how much? It's the total cost of the job, which you can tell right here, and you can also tell right here when we transferred it to finished goods inventory. Finished goods inventory goes down, cost of goods sold goes up. And that's it. So this is a really good review question or a review problem of how job order costing works.